Let's get perspective on how markets are trading as we head into the final stretch of 2019. We're joined by Diana Avigdor, Portfolio Manager, Head of Trading at Barometer Capital Management. It's always great to see you, Diana. Thanks for coming.
Thank you for having me.
Thanks for coming on the show. Well, last year, there was no Santa rally. It was a horrible time to be in stocks right until Christmas Eve. Very different picture this year so far.
Absolutely. We've had a wonderful rally this year in all North American markets. And I must say to investors, if you feel that you've underperformed the market, do not fret. So has everyone else. It took the first month of the year, rallied 10% of the 20 plus that we're adding up right now. So unless you knew exactly what the low of the day was or the low of the year was, you would have missed it, and it would have been very courageous of you to enter into a market that was down so much. So that being said, 10%, 15% would have still been a great return for this year, as the markets have exhibited a big rebound from to your point from end of last year.
Let's put up that old 5-year chart, because what a bottom. Just about everything it felt like bottomed on December 24th. Yeah,
absolutely.
I know. That
26th would have been the day to buy, but hey, who would have known it?
I know, that's right. People hangover, yeah, and still in their turkey coma.
Well, and in the down 20% for the quarter coma.
Yeah, that's right.
The scratching of the head, saying, what the hell happened in my portfolio, and why am I down 20% in 3 months?
That was unbelievable. Yeah, the year-end statements,
yeah.
And then the rebound was so quick, as you note. But you say investors, though, in the short term, should look for weakness and volatility potentially from here.
I think that we've had a very strong rally year to date. And usually in December we get some profit take, some operational transactions, and by that I mean people needing to straighten out their portfolios, their cash levels, their tax situation, offset some losses, some gains offset with some losses and so forth, or rebalancing as they need to do. So not everything at the last 2-3 weeks of the year have to do with long-term investing, and some operational issues ensue. Banks and other investors, corporates, do need to bring cash home, and leverage tends to be taken down to levels where when the executives go on holidays for Christmas and New Year's, then the companies can autopilot through year end without having any cash crunches. So there is a lot of operational issues happening in the end of the year. But what I want to highlight is that despite the fact that volatility, and we might have a short-term weakness that we've seen towards the end of last week and beginning of today, and today, we are positive on the market, and we feel that globally we are in a reflation period. And so investors that have missed out on this year, and there's lots of them, would use opportunity to invest at this point.
Do you think there are a lot of investors who've just missed the rally this year?
I think there is evidence, surveys, and all kinds of reports on cash flows, mutual funds, ETFs, and equities in general, where it's evidence that investors have been pulling out money. And also, to our point in the beginning of the conversation, a lot of people have missed the first third of this year's rally, fully not expecting after a 20% sell-off and a quick 10% rally, it wouldn't have given people confidence and courage to enter. So yes, I think that a large amount of people, percentage, I don't know majority or not, but a large amount of people would have either underperformed or not been in the market. We feel that the economic data is pointing towards a reflation. A recession is not what the stock market is telling you is going to happen, if you believe that the stock market is a leading indicator.
You have one kind of optimistic note here. We keep hearing, well, the Canadian economy, the Canadian stock market is all just oils and banks. But you say it's become more diversified lately with the addition of companies such as Canada Goose and Shopify.
That's exactly right. Canada is still highly dependent on foreign flows for its stock market performance and tends to do best when commodities are doing well. If a reflation trade is indeed in the cards, commodities will do okay, although we are not seeing currently the performance, the price proof in the energy companies, although there are some analysts that are already calling some of the Canadian energy companies in favor, just calling them being well managed with a good return on capital and share buyback. However, oil price needs to work, and yes, the Canadian stock market has not always reflected the Canadian economy, but it has changed a little bit as companies such as what you mentioned, Goose and Shopify, have entered the stock market to diversify, so you're able to diversify some of your holdings. Because for us asset managers to look to create a diversified portfolio for the clients, there are actual sectors that cannot be really found in Canada, so you do go outside for other sector exposure.
One story I saw today in the Wall Street Journal, I'd love to get your take on it, Diana. Apparently, quite a few portfolio managers in the States, in reaction to the indexing mania, are actually running narrower and narrower portfolios. So far, they've had trouble matching the market, but do you think that's a trend among managed money now to go for portfolios like the old Trimark ones, remember, with 30 stocks or less?
Yeah, there is a trend to it. So I'll start with this. The last, since the great financial crisis, so since 2008, trend following strategies have become very, very popular. And trend following strategies will follow what's strong, obviously, buy what's strong and sell what's weak. And what happens there is it creates a situation where the trend gets exacerbated from one side to the next as more money flows towards where most money flows. So in order to differentiate yourself, you were able, or you must want to become more concentrated. But that can only be done if you have a client base that is truly long-term. And what I find, and why I'm saying that is, when your client base is truly long-term, and you don't have to explain your holdings on a daily or monthly basis, then you can overcome the volatility, and the volatility has increased in the market. I'm sure you can feel it. It just goes much faster. Look at the last Q4 18 down 20%, and then just January up 10%. It's truly the volatility tends to get exacerbated. But so to the extent that people want to differentiate themselves, and the index, for example, honestly, there is a trend to by quant strategies to just flow, and ETFs to flow towards those most liquid. So money begets money, liquidity begets liquidity, and direction begets direction.
Liquidity begets liquidity. I love that expression as well. Yeah. Tell us, you do have an income portfolio that you manage, or your shop manages. Tell us how it's looking for income these days.
It's looking great. Again, there are some solid companies that have done pretty well in Canada here. So some of our largest weights in sector-wise is REITs. Granite REIT, for example, has a great return profile, wonderful organic growth, a steady yield. Canada in general, it has its volatile speculative side in the energy and the commodity sector, but it has solid companies that are stable, like our telcos, banks, and like I said, the REITs, that can provide a solid anchor to a portfolio that is, barbelled from a perspective of here is the the solid and regular growth and solid yield to something that perhaps has a little bit more growth portfolio. So you can pepper in some global financials as we feel that we're trading the reflation trade in our portfolios, so we can barbell those income portfolios to provide a solid yield for our investors and at the same time give us a little bit of extra growth.
And when you say reflation trade, just remind us what you mean, Diana, please.
Reflation means increased inflation, not deflation. Reflation is an increase in economic activity. You're looking in the U.S. at all-time employment lows. That will likely create an increased pressure in wages. And we already have a little bit of a hint from Fed watchers or Fed speakers that the Fed is willing to accept a little bit higher level or give the economy a chance of running a little bit hotter than it would under other circumstances, given the fact that we're now a decade into a slow growth, solid environment, which is okay. So reflation, that's what it means. Increase in the economic activity and inflation. And by the way, if there is inflation in the global economy, you can't do better as a hedge than equities.
Diana, always great talking to you. Thank you very much indeed.
Thanks, Andrew.
Diana Avigdor, Portfolio Manager and Head of Trading at Barometer Capital Management.